Good morning or good afternoon, depending on where you're joining us, and welcome to our KraneShares webinar, From Jupiter to Jiangsu, How Astrophysics Informs AI-Powered Investing. Joining me today will be the team from Quant Insight, Mahmood Noorani, and Professor Michael Hobson. Just a few housekeeping notes before we get started. We really want today's presentation to be lively and interactive. So please send any questions you may have to info@kraneshares.com if you are streaming on the KraneShares website. If you are joining us via Zoom, please just send your questions directly through the Q&A button at the bottom of your screen. For those interested, we are also offering one CIMA and CFP credit for attending today's presentation. Please send an email to ce@kraneshares.com if you would like to receive a credit for your attendance today. Thank you. So just a brief introduction to KraneShares for those of you who aren't familiar. Our founder, Jonathan Crane, spent many years building and eventually selling a successful business in China in the early 2000s. And he formed a variety of core beliefs about China during his time there. One was he experienced firsthand the growth of China's consumer economy and figured out that this would be a major secular global growth trend over the coming decades. And we're still seeing that trend play out. Number two was he realized that US and global investors did not have very efficient ways to passively access China's capital markets. And so he founded KraneShares in 2013 to provide that access. We've since expanded into two other pillars. We have a carbon credits fund in our climate category and also a variety of alternative strategies. With that, I will hand things off to Mahmood Noorani, CEO and co-founder of Quant Insight, to introduce you to our latest ETF, KCAI, the KraneShares China Alpha Index ETF. Mahmood.
Thank you. Hi, everyone. Very excited to be on this webinar to talk about the new China Alpha ETF that has been launched by KraneShares. I'm the co-founder and CEO of Quant Insight. We have been around about 8 years now. And our sort of core vision, if you like, is that successful investing is increasingly being driven by the rigorous analysis of data. Now, we hear about AI all the time nowadays, but when we look at capital markets, we really see that the first wave of AI and machine learning really dominated a lot of sort of efficiency tasks, whether that was middle office or back office, and productivity tasks. And we believe that we're now fully commencing the third wave of this, which is where AI starts to play a much bigger role in the investment process and how investment decisions are actually made. So what we do at QI is we create a lot of data analytics using machine learning. We have partnerships with firms such as KraneShares, of course, Goldman Sachs, Bank of America, Citibank, and others. And one of our core activities now is using machine learning to build investment strategies. And clearly one of those is on China. We were fortunate enough about 5 years ago, I think now, Mike, to start collaborating with Professor Michael Hobson at Cambridge University. And what was fascinating about Mike is that he was not only a leader globally in machine learning and Bayesian inference, but was already very familiar with financial market data and financial market dynamics. So it was a really fortunate accident for us that we started collaborating with Michael, and we started to learn a great deal about how to build robust algorithms. Now, when we look at the China Alpha, what's going on here is that there is a machine, an algorithm, that is looking at the CSI 300 stocks. So the 300 stocks that compose the CSI 300 index. Now, one of the biggest pitfalls of developing systematic strategies is what is called overfitting. And when you think about it, it is clearly an issue. If you sit here today, look at the 300 stocks. So you've got 300 price histories of the 300 CSI 300 stocks, and you figure out which, let's say, combination of 50 of those did best over the last 10 years. And you sit there and say, oh, look, these 50 stocks outperformed the index massively. That's going to be my trading strategy. The enormous problem with that is you are assuming that you have perfect knowledge of everything that's going to happen in the future, and you really don't. So how do you simulate real world uncertainty? Well, the way you do that is you take the machine back in time. And so the machine doesn't know anything about what's going to happen. Let's say if you go back 10 years, you're sitting there in October 2014. The machine has no data, no clue about anything that happened in the next 10 years. And what you do is, and you've heard this term probably, is you create a training window. You train the machine. And the machine takes the CSI 300 time series. And the problem the machine has is, how do I figure out which 50 stocks are going to outperform the index in my training window? And so that in itself is a major challenge. And the reason for that is, if you think about it, if I look at every possible portfolio there is, when you allow me to pick between 30 to 100 stocks out of 300, and if you allow the weight of any stock in any of those 30 to 100 size portfolios can be anywhere between 0 and 5%, what you end up with is about as many potential portfolios as there are atoms in the universe. Now, even with the best Excel spreadsheet and the best laptop, you're really not going to figure out which of those virtually infinite number of portfolios really gives you the best outperformance. It's just not possible. Now, it probably wouldn't have even been possible for us 10 or 15 years ago, but thanks to the dramatic cheapening of processing power, what's happening now in the industry is that a lot of these fantastic techniques around Bayesian inference and machine learning, neural networks, and so on, these things can all now be deployed thanks to the fact that we have such cheap processing power. So what KCAI is doing, and the way it was developed, is that it started off 10 years ago completely blind about the future, and it tried to find the best portfolio in the training window. And let's say the training window is a 1 year look back. That in itself, as I mentioned, was a challenge, and it requires some very advanced optimization that Mike will talk about later. And there are some other nuances here. You don't want a single isolated portfolio that does brilliantly on its own. You really want a cluster or a region of portfolios that are giving you a sort of stable region of outperformance relative to the index. And so you're sort of exploring this enormous set of possibilities in order to find this region of outperformance. And then the way you assess an algo is, once you've done that first training 10 years ago, you get a portfolio and you see how that portfolio does for the next month. And then the machine trains again. And you see how that second portfolio does for the next month. And then the machine trains again and rebalances. And the reason this is so important is because fundamental relationships out there change all the time, and there's a constant shifting around of market regimes and relationships. And so, given that processing power is so cheap, machine learning, the learning bit, is this sort of rebalancing, reoptimization, adapting to new market circumstances, and it happens on a regular basis. And in the case of KCAI, it is a monthly rebalance. And the reason that we found China so interesting, just to move on to a slightly different topic, is that China is a market where retail participation is very high. I think it's something like 70% of volume is retail driven. The second aspect, sorry, 66, just over 60%. The second interesting aspect about the Chinese stock market is that one can argue that it is perhaps not a complete or efficient market because it is very hard to short stocks and borrow stocks there. So there's a bit of an imbalance in that market there as well. And the third thing about the Chinese stock market is that I think one can easily argue that there's quite a bit of sentiment that drives it, particularly around geopolitical risk, internal political changes, and there are cycles where global investors get worried about China, and then cycles when they get optimistic about China. And it is, of course, very activist from a policy perspective, and we've just seen that in recent weeks. And so there's a lot of sentiment swishing around in the Chinese stock market. And we also looked at the typical alpha performance of fund managers who invest in China and found, let's just say, there's a lot of room for improvement in the last few years. And so adding all those things together, it seemed that taking this quite rigorous, systematic machine learning approach to the Chinese market was a great place to start. We are indeed also looking at other markets, whether that's India, Canada, and so on, because we believe that the way these very powerful machine learning processes can extract alpha is really, if you look at the advantages relative to human investors, in our view, machines will probably outperform, let's say, the bottom 70% or 80% of human investors. And of course, the great advantage that machines have is that they have no bias and they have no sentiment. They're really just looking at the data. And there will undoubtedly be times when, algorithms will be sitting with a portfolio. They can't see the future, but then nobody can. And you'll have some sort of regime shift or geopolitical shift or economic event that will come along. And the portfolio, the optimal portfolio that it's found, will no longer be the optimal portfolio for the following month. But the beauty is it adapts and it retrains. And it's that consistency that it is a repeatable process that is devoid of sentiment and emotion. That means that over the long term, it has a very good chance of delivering very attractive performance. So I haven't gone into too much of the kind of scientific detail around how the optimization works. I think one thing that's sort of worth mentioning is that these approaches are very flexible. So you can develop algorithms for the objective function of your choice. And what I mean by that is that you can develop algorithms that are long only or long short, or where you're maximizing total return, or you're maximizing outperformance to an index, or indeed where you're maximizing Sharpe ratio. You can set a volatility target. The framework for building algorithms is incredibly flexible and incredibly powerful. And that is why, we will be looking at other markets. I will mention that our research, unsurprisingly, suggests that one of the hardest markets, and we have more work to do there, to generate significant alpha outperformance is the S&P 500. You can get a little bit of alpha, but it is clearly a market with many incredibly sophisticated players. It has a great deal of liquidity. It has huge numbers of global participants analyzing all the information to death. And so you can eke a little bit out. But I think that sort of fits the expectation that as markets get super efficient, even the most sophisticated machines won't generate the sort of alpha we feel we can generate with China. And so, given how much available juice we believe there is, given the inefficiencies in the China market, as discussed, we're very excited about the China algo and KCAI. And with that, Mike, I will leave you to go into some of the juicier scientific aspects of this.
Okay, well, thank you very much, Mahmood. Hello, everyone. My name's Michael Hobson. I'm Professor of Astrophysics in the Physics Department in the University of Cambridge. And I've been researching there actively for over 30 years now. I have a range of interests. Primarily, my research is focused on theoretical topics, largely related to theories of gravity and their application to the physics of the early universe, in particular cosmology, and how the universe came into being and the structure within it evolved to give us the universe that we see today. So aside from an awful lot of sort of pen and paper and computational work on theories of gravity and cosmology, I've always been a very firm believer that in spite of being a theoretician, one should always ask nature what she does from time to time. So around a third of my research experience over the last 30 years has been associated with the design, operation in some cases, and certainly the analysis of a range of astronomical instruments. They vary from some telescopes just outside the university here in Cambridge that I've designed and operated, through to instruments sitting on mountaintops around the world, such as in Tenerife or Hawaii, and even to very large international satellite projects by NASA and the European Space Agency, ESA. As part of that work to ask nature what she does, one has to analyze very large data sets. And one might wonder why an astrophysicist or cosmologist such as myself can really bring anything to offer in the world of finance. Well, it really comes down to the fact that financial data sets share an awful lot in common with astrophysical data sets. They're very large data sets. Often one is seeking to identify particular signals that are very faint, buried in a lot of extraneous signal that you don't want, or often called noise. And so in cosmology, one is seeking to extract science from very faint signals embedded in noise and systematic effects to get at the science. And financial data sets nowadays are very similar. One has a vast amount of financial data going down to the tick data level, in some respects, going back many years, decades in some markets. And so one is presented with a wealth of data to mine, to examine, to search through. So that's really why the two subjects aren't as far apart as one might first imagine. So in astrophysics, my research in the analysis of cosmological and astrophysical data sets has centered upon the development and the application of a number of methods that are based in the areas of statistical inference, primarily a methodology known as Bayesian statistical inference, and also applying that in the area of machine learning or artificial intelligence. And over the years, I've built quite a number of bespoke analysis techniques that have been used around the world, really, in all parts of astrophysics. They've also been deployed in other scientific endeavors, geophysics in particular, and also areas of medical imaging and cancer research as well. But the interesting thing about my work with Quant Insight is that now these methodologies have also found a home in finance. So let me tell you a little bit about the sort of approaches that we take. As Mahmood mentioned, if taking the China index, CSI index as an example, if one wishes to create combinations of stocks in that index, you don't know a priori how many stocks you should take in order to achieve a particular return or alpha or Sharpe ratio. You don't know how many you wish to take, and you also don't know what weights to give those stocks, whether you should buy more of one than another, whether you should be long one stock, or even in the Chinese market, sometimes short another stock. And if you do a simple-minded calculation and figure out just how many combinations of potential portfolios there are, the numbers really are astronomical. Mahmood mentioned the number of atoms in the observable universe. That's around 10 to the 80. And that's about the number of different types of 100 stock portfolios one can make from the CSI. We tend to make them slightly smaller than that, but still the number of potential portfolios is still of order sort of 10 to the 40 or 10 to the 50. And so at first sight, it seems a hopeless task to expect a machine learning algorithm to be able to navigate its way through such a large potential space of portfolios. Fortunately, similar problems occur in astrophysics. In particular, they occur when one is looking for the particular types of, when one is looking for discrete objects buried in background emission, essentially is where it comes from. And so we have developed techniques that allow one to navigate such spaces. One thing to bear in mind is that when one is building an algorithm to return a particular alpha, one has a number of parameters within that algorithm that one can choose to vary. And Mahmood mentioned how that process is done using historical data in a sort of rolling fashion that never sees the future. But in the parameter space that defines the potential trading model, you have this vast potential number of different portfolios and the weights therein. The important thing to take away is that what we don't do is isolate a single point in that parameter space. The techniques that we've developed in astrophysics have shown us repeatedly in that context, and similarly since we have found in finance, that one has to explore the whole space rather than simply attempt to locate isolated islands of high return. The market is a dynamic entity, and you can imagine in much reduced dimensionality, you could imagine a hillside or a mountain range where the height of the mountain range tells you the quality of the algorithm. It could be the return, it could be the Sharpe, whatever. And the sort of the two directions you could go at ground level could be two of the parameters that define that trading model. Well, what you don't want to do is get stuck at a single little point in the foothills of that mountain landscape. What one wants to do is identify broad regions of profitability by being able to navigate that entire mountain range, but in very many more dimensions. And that's absolutely crucial to avoid what Mahmood also mentioned, which is the curse of all automated trading algorithms, overfitting. Because as time passes and market paradigms shift, one finds that that mountain range, if you still have that picture in your minds, one finds that that mountain range also shifts. It generally, however, only shifts in its small scale structure. So the individual ridges or small peaks of that mountain range may come and go and move around quite a lot. But the broad brush of the landscape tends to be reasonably stable. And if it does change, that broad landscape structure tends to change rather more slowly in ways that one can follow with the trading algorithm. So provided one can navigate the entire space and identify stable, broad regions of profitability, one is insulated from the vagaries of overfitting and the issues that can arise with occupying just a small, narrow, low-lying peak in this landscape of profitability. And so those techniques that we developed in astrophysics therefore have a direct relevance to the building of these algorithms. And in particular, it allows us to identify the number of stocks that are most appropriate. It allows us to identify the weights that those stocks should be given. It also allows us to satisfy any constraints we wish to place on those stocks. Mahmood mentioned some of those earlier. They could be, for example, particular long-short ratios or whatever. So we have the capability to navigate large, complicated spaces subject to arbitrary constraints in a way that allows us to obviate the issue of overfitting and generate reliable alpha in a systematic, machine-learned way. So I think that's all I would like to say about the sort of meat of the technology. And I'd like to hand over now to Henry Greene, who I believe is going to tell us a little bit of a market update.
Thank you. Thank you, Michael. Yeah, it's a pleasure. As some of you watching may know, China's capital markets have had some interesting developments recently. Unprecedented stimulus was announced just a couple weeks ago, which led to a significant reaction in the markets. So we'll just go through to start off kind of what happened, right? The first announcement was around broad rate cuts, right? So they cut the repurchase ratio in the short term, or the reserve requirement ratio, and loan prime rates. So that's really key for the market. This is something that we had kind of been waiting for. They've been cutting rates kind of around the fringes for the past year, I'd say, but they really doubled down on their rate cuts in that week in September, that September 26th, I believe it was. And so that creates a couple effects. Number one is on mortgages. So you're going to have a lot of families kind of refinancing their mortgages, which is going to release a lot of money into the system and enable people to either invest that money or spend it on consumption. And then we also had on the real estate side, as some of you may know, real estate has been a particular pain point for China's economy. A guarantee that unfinished homes, which were promised by major developers and pre-purchased over the years, but weren't delivered. So the government will be providing a backstop for those homes to be delivered. And finally, on this slide, we also saw that Beijing, Shanghai, and Shenzhen eliminated the home purchase restrictions that began in 2022 when the government went on this deleveraging campaign in real estate. Next slide, please. So now we'll get into some of the more stock market oriented and fiscal policy measures that were announced. So number one is a 500 billion renminbi swap facility that will provide additional liquidity to brokerage houses, mutual fund families, and insurance companies, provided that they use those funds to actually purchase stocks. And this isn't just a one-time thing. As Pan Gongsheng mentioned on September 4th, that they have the option to expand this program and do multiple rounds in the coming weeks and the coming months. Meanwhile, they also announced in pursuant to and kind of following up to when we had the 9 measures announced just a few months ago, stock buybacks are a key focus of regulators in terms of developing the market and really kind of shoring up investor confidence. So they're going to provide an additional 300 billion renminbi at least companies to fund their stock buybacks. So how are they going to fund this? Well, part of that's going to be renminbi $2 trillion, renminbi, excuse me, in special bond issuance. That's going to go to households for consumption, and that could include, again, we don't have the details quite yet, but that could include payments to consumers. They will also introduce kind of dynamic spending policies to stabilize, again, consumer confidence, real estate market, and the stock market. And hopefully the hope is that that will also help improve employment rates, which have been another pain point, especially for recent graduates. And then also to banks, they're going to offering a 1 trillion renminbi injection that's to raise their tier 1 capital. So that's already been done, and they're also likely to do more of that. So some of these fiscal measures, right, they've been alluded to, but we're still waiting on further details, right? So we're anticipating further articulation to occur at the Politburo meeting, also at the NPC Standing Committee, and State Council meetings. And that could come as soon as this weekend. We have the Ministry of Finance will hold a special meeting actually on Saturday, where it's likely that we'll get some more clarity on how these fiscal policies will actually look. So again, the market reacted quite forcefully initially to the stimulus measures being announced, but we've seen a little bit of a pullback recently because I think investors are looking for more clarity on the actual fiscal policies. So we have monetary, that's already known. Fiscal, they've alluded to, and it's looking quite positive, but we still need to get those specifics. If we move on to the next slide. So why are they doing this, right? I mentioned, I alluded to this already, but China's economy has been facing some challenges. We like to say that they're very much are growing pains. They're going from a developing economy to being kind of a middle income to developed economy. And some of these are pains that you can expect, and some of them are granted unique to China, right? So first is real estate. Basically, in 2022, they decided to significantly deleverage the real estate sector. You had, by many accounts, this was somewhat of a bubble in some cases, where you had families buying multiple homes, and they wouldn't even be renting them out. They would be just sitting on them as investment properties with the expectation that for the value to rise. So 60% of household savings in China is in real estate. This has been historically the case for cultural reasons, and also because until recently, there weren't very many other options for Chinese citizens to invest their money. So real estate was seen as the safest investment. Obviously, we see that changing with the development of China's capital markets. Second one, and again, these are all there's a domino effect here where if you perceive that your real estate price is lower, that your home values are lower, you're not going to spend as much. So we've seen a significant drop in consumer confidence. I would note, though, that recently this consumer confidence is mostly focused on physical goods. We've seen a huge surge since the pandemic in spending on services and travel and experiences. A colleague of mine in China mentioned that people after the pandemic feel that life is short, and they want to spend on experiences rather than physical goods. So we really want to see the physical goods consumption rise, and that's part of the policy package we've seen announced. And then you also have fixed asset investment in manufacturing. So that's been a priority for the government until recently. We see them kind of shifting to focus more on the consumer, which is important. And China's manufacturing, China's export numbers have been quite good, quite strong, much stronger than these other economic indicators we've noted in recent years. However, as we have the quote here from the PBOC's Q3 Monetary Policy Committee, the world economic growth is coming down a little bit. They're not certain that they can export at the same level anymore, right? And so they've tried very hard to keep exports as strong as possible, but now they really need, and we've been saying this for a while, but now they really need to lean on domestic consumption. Next slide, please. So how can they do this, right? I mean, governments all over the world are facing higher and higher debt levels. We've seen a massive, tightening cycle in the United States and most developing economies. So, how is China able to ease so significantly? Well, they have a great amount of dry powder, so to speak. Foreign reserves of over $3 trillion US dollars at the sovereign level, right? So we've seen some debt issues in local municipalities and private companies, especially real estate developers, stemming from the deleveraging. But at the sovereign level, China has one of the strongest balance sheets worldwide. Why is that? Well, primarily, it's because of it was the case before the pandemic, but it's become even stronger given the massive stimulus that the United States and the countries in the euro area implemented during the pandemic. China did, it's estimated under $500 billion worth of pandemic stimulus compared to 5 trillion in the United States and over 2 trillion in the euro area. Next slide, please. So why are they doing this now? Well, as I mentioned, we've been saying for quite some time now that they're going to intervene, right, in the economy, in the stock market, right, to shore up investor confidence, shore up consumer confidence, right? But why did they wait until now? Well, that's because they were waiting for the U.S. Fed to cut rates. So as you see here, the currency, generally renminbi, responds very positively to easing cycles in the United States. If they were to have cut rates so significantly prior to any interest rate cut in the US, the concern was that it would have had an adverse impact on China's currency and therefore its purchasing power. So once they saw the Fed cut rates, they really didn't wait any longer, and they cut rates even more so shortly thereafter. Let's go to the next slide, please. So what does this mean for investors? Well, US and global investors are underweight China compared to the benchmarks that they use. It's actually interesting that MSCI Canada, at least as of this data as of September, had a larger market cap, larger weight in the MSCI All Country World Index than China, despite China's economy being 18 trillion versus Canada's 2 trillion. But even so, right, that investors are not even at that benchmark weight. Okay, we're seeing on average in actively managed funds 2 to 3% underweights to China versus that benchmark. So that's an extremely, probably a historic low positioning towards China. So we think that these stimulus measures are going to give investors the confidence to reallocate to China. Next slide, please. Yeah, and so as you see, to support this thesis, right, we've seen a massive interest in U.S. equities due to the U.S. market's outperformance over certainly the past 3 years and arguably the past 10 years. Foreign ownership in U.S. stocks really surged in 2022. And this is from data coming from the Treasury Department in the U.S. Right. So even investors outside of the U.S., it's not just that U.S. investors aren't investing abroad, it's that investors from abroad are very, very interested in investing in the U.S., and that's where they've been putting the majority of their capital in terms of their equity allocations. Next slide, please. So how is money gonna come back into China? Who's gonna come first, right? So we've already seen hedge funds such as David Tepper. He was on CNBC, talking about how he's going back into China with the stimulus measures. And so that's kind of fast money, we like to say, right? So that's already moving. But it's going to take a much longer time for larger institutions to move money back into China. And so we see that's going to take, probably over the next few months, quarters, maybe even the next year, to fully kind of play itself out, right? So we see that kind of being the the order in which, money's going to come in, right? It's going to be the hedge funds, it's going to be the fast money first, and then you're going to see institutional money. We also see this disparity on geographical lines, right? Because you had the US investors were the first to kind of pull out of China, and then they were followed by European investors, and then followed by Asian investors. So we're going to see the flows coming back to happen in the opposite order. With you have local investors, Asia coming in first, and then Europe, and then the United States. Next slide, please. Right. So mainland investors, this is one positive we see in the market, right? Where, they've purchased over $100 billion worth of Hong Kong stocks and ETFs. So that's mainland money going offshore. Right. And that's really positive for the market, right? And so you've seen that's 2024 year to date, right? Is already far, far above 2023's total. And so that's very significant, and it shows a significant interest from mainland looking investing offshore. Okay, but and that was kind of the trend earlier this year, and now we're seeing actually mainland investors going into the A-share market, which is again the Shanghai and Shenzhen listed stocks that we hold in KCAI. And then if we could go back to, I think, slide 18, right, just to look at kind of the year-to-date performance. Yeah, so China's equity markets, thanks to this massive stimulus package announced, are now leading global markets. Global markets, including NASDAQ, S&P 500, and emerging markets outside of China, which is something that we track quite closely using our KEMX fund. So right now, KWEB, which is China Internet, so that can basically represent growth stocks listed outside of China. So the offshore market is kind of outperforming A-shares right now. And we see that there's a bit of a lag here, where you have kind of what offshore is reflecting what international investors think. And we've seen that rise up significantly over the past few weeks. And it's taken more time for the mainland market to react to this. But onshore investors are seeing what's happening offshore, and that gives them more confidence to invest in their own stock market. So that's really key. So we actually think there could be potentially a little bit more upside in China's A-share markets because they haven't yet reflected this offshore increase in the stock prices. So we think that's really positive for China A-shares going forward. And of course, again, the A-shares are where these stock market stabilization funds, where the swap funds, where local money is going to go. So that's going to be the direct beneficiary of these fiscal spending policies, and already is the direct beneficiary of the monetary policy, more so than the offshore market. So with that, I think we already have some questions coming in for the team. I think especially for Mike and Mahmood on the AI, our AI KCAI strategy in China A shares. So let's see. The first, let's see here. So we have a couple questions about the time frame for the machine learning algorithm to outperform over, right? So, when you're looking at comparing performance with KCAI versus other other indexes, right? What is kind of a fair time horizon to use when making that kind of comparison?
A reasonable sample is the 9 to 12 month horizon. We ran this sort of blind simulation for about 7 years and then tracked live for about a year and a half and found this strong performance. And so going forward, clearly the longer you give it, the better the sample. And my rough estimate would be a sort of 9 to 12-month horizon should see the averages of the noise over that period even out and the outperformance to show.
Great. Yeah. So looking at kind of a 12-month period there.
I'll
And
also say that, we'll see if China can move from kind of an expectations-driven market to an actual, pickup in economic growth and activity. That will certainly favor the strategy, the KCI
oh,
strategy.
right. So we have another interesting question. Now I know that really the only inputs used in the machine learning algorithm are price,
Yep.
right? So we do have a question about the types of companies that AI
Yeah.
favors and whether there are any
So,
patterns there. But given that it's only price, right? I think
well, what's interesting is that we do look at, for example, the sectors that the machine has decided are sort of the regions of stable outperformance. And what's interesting right now is that it favors industrials, financials, and materials. And so those you would expect to do well if China economic growth actually picks up. So that's the sort of the current sector bias of KCAI, industrials, financials, and materials.
that's That's interesting. I mean, I know it's not looking at economic data, or economic
I think,
forecasts, so it's
yeah, and
interesting
I
that
think there's one other thing that's really important to bear in mind, and that is that there's another constraint we've put on this, which is the beta to the market needs to be around 1. So
right.
it's one of the pitfalls of asking a machine to go and outperform an index is that it will sit there and look at the training window and say, okay, that's easy. I'll just buy high beta stocks. Now, the problem with that, of course, is that when markets are rising, that's great. But when they correct, the high beta stocks do, the worse. And so you get this extreme high volatility version of the market, which isn't great. For it to be genuine alpha, you want it to outperform, even though it has the same beta as the market. And I think the beta range is around 0.96 to 104. So it's really, beta neutral. So you'll have phases where market volatility is high and the market's rising and the algo will lag, and you'll have other phases that are more, representative of normal market regimes. And it's outperforming without taking a beta bet, which I think is very important to note.
Yes.
Okay. So we've got another question about I think it's about KCI, but I think it applies to our China ETFs, A-shares ETFs more generally, which is, how they trade when the underlying markets are actually closed, right? So we saw this play out recently with the national holiday that was 1 week long. We saw, given the stimulus announcements and a lot of euphoria around the stimulus announcement, we saw a significant run up in our ETFs that track A shares specifically in US trading hours, right? Even though those prices weren't yet reflected in the underlying markets. So, yes, there can be a difference there, right? Our ETFs do provide liquidity and some degree of pricing when mainland markets are closed. Of course, always be careful and cognizant that of trading of the additional risks, right, when you're trading these products when the underlying markets are closed. Um, so I mean, we have another question about liquidity. Um, of KCAI that it is limited. And I think,
Okay.
we have the holiday, right? But, also, sorry, Mahmood, did you?
I was just pointing out the holiday comment that you made that, given the Chinese national holidays for a week, that perhaps had a negative impact on liquidity and interest in China.
Yeah. I mean, well, it's interesting, because for some of our products, we did see a significant demand during the holiday, right? KCI is a little newer strategy, right? So, it can also take time for, the best liquidity profile for the fund to develop, right? And that's, another something that people looking to invest should be cognizant of. Um, and then okay, similar question around the bid ask spread, right? Again, that also probably comes from both the fact that the ETF is new and also due to the holiday, right? And let's see if there's anything interesting here. So a few questions about China stimulus I see coming in. Um, so as I mentioned, there's another meeting this weekend from the Ministry of Finance. And so hopefully we're hoping to see some more specific fiscal measures announced, right? So we had the NDRC, which is the National Development and Reform Commission meeting. We had that on Wednesday um, this week. And, a lot of people were expecting that body to announce the consumer stimulus, right? But that's not actually what the NDRC does. NDRC is more focused on, having the money that's allocated to them and using it to invest in things like infrastructure and social services. So consumer stimulus, we should hear more about that. That's more likely to come from the Ministry of Finance or from the State Council. And again, we have the Ministry of Finance meeting this weekend. So we should have more announcements around that. Um, let's see here. Another comment. On stimulus, will China scale down its stimulus if the Fed eases less? And it does not meet what is expected. Yeah, so we've had this we've had this question in previous webcasts. And our opinion is this is for China, this is a moment that is similar to the ECB's moment back in 2014, 2013, when Mario Draghi said, we will do whatever it takes to protect the euro, to preserve the euro. And obviously you had where Northern Europe didn't want to support Portugal, Italy, and Greece in keeping the currency afloat and doing bailouts. But the ECB president said no, we're doing whatever it takes. So I think that even if the Fed doesn't ease as much as expected, I believe that China will continue with significant stimulus measures, significant backstops for real estate, and support of the stock market. I think that you see they have significant dry powder as discussed. Also, they have room now, given the strong move in the currency, down to just about seven, which is an important level psychologically speaking. That's 7 renminbi per $1. That's actually up from it was at almost 7.3 earlier this year. And you've actually seen with the fixing has been more allowing for more depreciation than some would expect. So given that strong appreciation we had in the currency, I think they've got a lot of room there to move, regardless of how the Fed continues its easing cycle. Let's see. Other questions. Yeah, so there's a question about KCAI and its performance over the course of the recent rally. Mahmood, do you want to kind of address that, right? How much,
Yes.
what was our
So
kind of up capture?
yeah, so I don't have the very latest. And what we saw in the first 3 to 4 weeks before the stimulus was fairly steady outperformance. I think it got to 1.2% in the first month, something like that. Then when the rally began in the initial phase, it kept up with the index. And then in the second part of the rally, I think we saw a few percent underperformance. And we're just trying to see where it comes out this week as the dust starts to settle. I think one thing that isn't surprising is that when you have massive short squeezes, it tends to be the most shorted stocks that people really hate that just go higher, go up the most as the short squeeze and the short covering accelerates, and it's all positioning driven. So to some degree right now, probably the best performing stocks are the ones that have seen the most short covering. And so what we need to see now over the next few days is the dust settles and this market settles down, where it all settles.
Right. Yes, thank you, Mahmood. So our next question is for Mike specifically, and it's about the Juno probe. And they're asking, can you tell us what was the key discovery, and are there any other planets that people should be interested in exploring?
Sorry, there's a slight problem with the internet connectivity there. The question on the Q&A about what did the Juno probe discover and what other planets might be interesting?
Well, the discovery of the Juno probe.
Sure. Okay. Well, I mean, the Juno probe. I was involved in the Juno probe because ESA wanted to determine the optimal launch window for the Juno probe, but when one is seeking to optimize launch windows, the function that you have to optimize is very complicated. And the optimization schemes that they were using weren't giving sufficient accuracy. So it was actually the optimization methodology, the very same optimization methodology that we use as part of the portfolio building, that ESA used to determine the launch window. So I wasn't a scientist working on the actual Jupiter science itself. I helped them out with their optimization for the launch window. I do happen to know the Bain results that it produced, however. I mean, it did an awful lot. Its primary goal was to give insights about Jupiter's kind of core, its magnetic field, its atmosphere in particular, and it also was provided the first views of Jupiter's north pole. So it found that the amount of water in Jupiter's atmosphere. It discovered particularly that Jupiter's core isn't kind of solid; it's a more diffuse, perhaps made of metallic hydrogen. It, as I said, imaged Jupiter's north pole and showed sort of the weather activities and storm systems around the north pole. It looked at the storm systems, in fact, all over the planet, and found that there were much sort of deeper, taller storm systems than expected. And it also detected time variations in Jupiter's magnetic field. So it basically gave us a wealth of information on the sort of physical structure of Jupiter as a planet. My direct research isn't really in planets at all. I would say that where I have done some planetary science is again using the optimization schemes that I've developed and since deployed in finance. I have been able to assist in the detection of exoplanets, and also in particular being able to calculate probabilities of certain exoplanets' existence. So I'd say the most interesting planets are not the ones in our solar system; they're the ones around other stars, exoplanets. They are.
Right. Yeah. Interesting. And we'll I'm sure a lot of attendees will be curious to hear more and follow NASA and you. I don't know if you have social media, but it'd be great. So last question we'll get to today, I think, is, and this could be for either of you, Mahmood or Michael. It's you know, AI and machine learning capabilities are progressing very quickly. It seems every few months, right? There are new developments, right? Do you intend, or so the question is, how is that going to affect investment decisions? But I guess, does our, machine learning algo, does it adapt on its own? Do you update it based on the latest developments, or how can we expect the algorithm
So,
itself to evolve over time?
yes, I guess general and specific, I can do the specific. And that is that we are constantly doing R&D to see if, for example, optimization methods can be improved, made faster. And so that is ongoing, and to the extent we find robust improvements, we can think about incorporating those. So that's the sort of specific to the index. In terms of kind of AI and machine learning generally and investing, I don't know if Mike, if you have any thoughts about.
Well, yes. I mean, the technology, we're always looking to keep our technology at the absolute forefront of what's available. So that's an ongoing process. So firstly, the AI systems that we build are dynamic and do learn from new information. But the question is more, as AI methods themselves develop, we update our approaches if and when we feel that there are new techniques that can be useful. More generically than that process, then yes, inevitably there have been a number of breakthroughs, particularly in large language models, over the past few years. Anyone who has engaged in a conversation with ChatGPT or Claude or whatever over the last couple of years will be astonished by the capabilities of the large language models. I mean, they're very knowledgeable, some might say intelligent chatbots. They provide the sort of general large neural network capabilities that now exist, clearly have some potential applications in investing. And it's an area that I and others are interested in pursuing. Quite how they can be harnessed in a way that gives investors the robustness to the sorts of issues that we were describing earlier remains to be determined, however. If ChatGPT happens to give you the wrong citation or something for a particular scientific result, it's not really a problem. If a large language model were to tell you to buy a certain selection of stocks without giving you a fully robust assessment of the risk profile, which it can be wont to do, that's a more serious outcome. And so it's trying to leverage the capabilities of these large neural network models while maintaining a strict risk analysis profile. That's really the challenge, and it's a challenge that we are engaged in researching, obviously. Okay.
Great, thank you. All right, well, I think that's all we have time for today. I want to thank
Everyone.
Mahmood and thank you, Michael, for
Sure.
joining me today for this great discussion on KCAI. Again, that's the KraneShares China Alpha Index ETF. Quite a unique product that we're very happy to have partnered with Quant Insight, a leader in the AI investment analysis space, to develop, focusing on China. And we hope we can develop more products with Quant in the future as well. And thank you to our attendees for joining us today. We hope you enjoyed the discussion and found it useful. And any more questions, or if there's anything we didn't get to today, feel free to reach out to us again at info@kraneshares.com. Thank you very much.
Thanks,
Bye.
everyone. Bye.
All right.
Bye.